Welcome to the CFA Level I presentation on cost of capital. So cost of capital is the rate of return that suppliers of capital, which is bondholders and owners, i.e. equity holders, require as a compensation for their contribution of capital. Each source becomes a component cost of capital, and marginal cost is the cost of raising additional funds for a potential project, potential investment project. This is also referred to as MCC, or marginal cost of capital. So what's the basic idea here? So for a given firm, there are two primary sources of capital. One is money coming in from the owners. This can be referred to as equity capital, and the other source of money is coming in from the lenders. These could be bondholders or the bank, but basically somebody who is loaning money. So this would be debt. So both these suppliers of capital expect a return. The lenders expect a return in the form of an interest rate. Equity holders expect a return in terms of dividends, capital gains, and so on. And essentially cost of capital is the overall or the average return that a firm needs to give to the suppliers of capital. In this simplistic case, we have two components. One component is the equity component, so there will be a cost of equity which we will generally denote as RE, and there will be a cost of debt which we will denote as RD. Marginal cost means what's the cost of raising additional funds. So if a firm has already raised 10 million, and for this 10 million, let's say that the average cost or the cost of capital was 12%. Now the firm is going out to raise another 1 million, and to raise this additional 1 million, if the cost of capital is 14%, then we say that the marginal cost of capital is 14%. Cost of capital is an extremely important concept. It is used in investment decision making by a company's management. It is also used in the valuation process by investors. A company invests in projects that produce a return in excess of the cost of capital. So in the earlier reading, we studied the concept of IRR, which essentially is the return on a project. Let's say that a return on a given project is 13%. This return has to be compared with the cost of capital. So if the cost of raising funds for a given company is 14% and the internal rate of return on a project is 13%, then it does not make sense to go ahead with this project, and so we will reject the project. On the other hand, if the internal rate of return is greater than the cost of capital, then we will accept the project. Given this extremely important usage, the estimation of the cost of capital is a central issue in corporate financial management. So any major company will have a figure for the cost of capital, because that is the basis for, often the basis for accepting and rejecting projects. This number, the cost of capital, is also sometimes referred to as the hurdle rate, because this is the hurdle level that must be cleared in order for a project to be considered. And as a general point, the riskier a given investment's cash flows, the greater its cost of capital, and we will study this in more detail later. If you are just given that a company's cost of capital is 14%, this means that this is the cost of capital for an average project. And very quickly, if a project has more risk than average, then the cost of capital will be more than 14%. If a project has less risk than average, then the relevant cost of capital that we take should be less than 14%. More on this later. So now here is the central equation that you must know, and you should put this down on your formula sheet. But what this says is that the weighted average cost of capital, and you will see soon why we call this the weighted average, is given by this equation. And here we are assuming that there are three components of capital. There is debt, there is preferred shares, and there is regular equity or common shares. So the formula for weighted average cost of debt is equal to the weightage of debt times the cost of debt times 1 minus t plus the weightage of preferred shares times the cost of issuing preferred shares plus the weightage of common equity times the cost of common equity. And now we are going to understand these terms in a little more detail. So when we say weightage of debt, preferred shares and equity, we are referring to the relative market value. So to take a simple case, let's say that for a given company, the market value of debt is 20 million, the market value of preferred shares is 30 million, and the market value of common shares or equity is 50 million. So in this case, the total market value for all three components is equal to 100. The weightage of debt will be 20 over 100, which is 0.2. The weightage of preferred shares is going to be 30 over 100, which is 0.3. And the weightage of equity is 50 over 100, which is 0.5. RD refers to the cost of debt. So this is the return that debt holders or bond holders are expecting. So in this simple example, let us say that bond holders are expecting 10% or 0.1. So we say 0.2 into 0.1. And then since the interest paid to debt holders is tax deductible, that effectively reduces the cost of debt, and hence we multiply by 1 minus the tax rate. So let's say that the tax rate is 30%, then you do 1 minus 30%, which is 1 minus 0.3, which is 0.7. Let's say that the cost of preferred shares is 12%, so that is 0.12. And finally, let's say that the cost of equity is 15%. So here we would say weight times cost, which is 0.15. So that's a quick explanation. We will see these items in more detail very soon. Let's first look at a quick example, and this just reinforces what we were talking about. Assume that IFT Corporation has the following capital structure: 30% debt, 10% preferred stock, 60% equity. IFT wishes to maintain these proportions as it raises new funds. Its before tax cost of debt is 8%, cost of preferred stock is 10%, cost of equity is 15%. If the marginal tax rate is 40%, what is the WACC? So again, we are using the same formula. It's very simple but important enough that we look at it twice. So this is the 30% debt. So that's the WD, is 30%, times this is the before tax cost of debt, that's the RD, and this is the 1 minus T. So 1 minus the tax rate. Again, we do 1 minus T here because the interest paid on debt is tax deductible, plus 0.1 into 0.1. This comes from the 10% preferred stock, so weightage of preferred stock, multiplied by the cost of preferred stock here is 10%, so that's the RP, plus 0.6 is the weightage of equity, which is given right here. So this is weightage of equity, and 15% is the return on equity. So that is RE. So we do the maths and we get 11.4%. Now let's look at another example. You gather the following information about the capital structure and before tax component costs for a company. The company's marginal tax rate is 40%. What is the cost of capital? Now here the core point is that given both book values and market values, you are supposed to use the market value. Very often for debt, the market value and book value will be quite similar, but core point is that if you have both, use market values. So how do we do this? The overall sum of for all three sources of capital is 300, 390, 410. So 410. So we again take the component, each component, and multiply it by each weightage and multiply it by the component. So what's the weightage of debt? It's 90 over 410 multiplied by 8%, 0.08, multiplied by 1 minus the tax rate, which is 0.4, plus we then do preferred shares, 20 over 410 into the 10%, which is 0.1, plus 300 over 410 into 0.14, which comes from here. So then you can just do the maths and get the weighted average cost of capital. And by now I'm sure you've realized why we call this weighted average, because we are weighting each of these returns based on the relative percentage of each component of capital. So weights in the calculation of WACC should be based on the firm's target capital structure. So this is another important point. On the earlier slide we talked about the importance of using market values rather than book values. On this slide we talk about the importance of using target capital structure rather than current or past capital structure. So the target capital structure is the portion based on market values of debt, preferred stock and equity that a firm expects to achieve over time. So the idea here is very simple. If a company currently has debt 50% and equity 50%, but is headed towards debt equal to 40% and equity equal to 60%, then in the usage in our weightages, we need to use these relative weights of debt and equity. So we need to use the target capital structure and not the current or the past capital structure. In the absence of any explicit information for a firm's target capital structure, an analyst should use the current capital structure based on market values. So this is one possibility. So essentially we are saying if we don't have any information about the target capital structure, then it might be reasonable to just use the current structure. We can also look at the trend in the firm's capital structure. So if we see a trend whereby the percentage of equity is going up, then we can extrapolate from that trend and come up with the most likely target capital structure and use that in our calculation. And finally, another strategy is to use the average of comparable companies. So if we have no information at all about the capital structure, then we can look at comparable companies and take an average. Here is a small example that gets a lot of people confused, and hence I will cover it here. Suppose a company announces that the debt to equity ratio is equal to 0.4, and it says that this ratio reflects its capital structure. So we simply have two components, debt and equity. So in our WACC formula, what weights should we use? Now a quick response that some people come up with is 0.4 and 0.6, and that will be wrong. So we need to figure out what in this example, what's WD and what is WE. The way you can think of this is just come up with some imaginary numbers. The way we have 0.4 over here, you can say if debt is equal to 1 and equity, so actually let's say debt is equal to 0.4 and equity is equal to 1. This is going to give debt over equity of 0.4 over 1, which is 1. So essentially this is saying that for $1 of equity we have $0.4 of debt. So what is our total funding, debt plus equity? It is 1.4. So debt as a percentage of total then is 0.4 divided by 1.4, and equity as a percentage of total is 1 divided by 1.4. And using the calculator very fast, so 0.4 divided by 1.4 is equal to, so this is equal to 0.29, and this is equal to 1 divided by 1.14. Actually 1 divided by 1.14 is 0.71. So obviously these two need to add up to 1. Now let's talk about the concept of optimal capital budget, and here we are looking at two lines or two graphs. First, let's look at the marginal cost of capital, which is what we've been talking about all along. So as you can imagine, if we have the amount of new capital on the x-axis and the cost of capital on the y-axis, then as you try to raise more and more capital, the cost of capital will increase. The idea being that for the first 20 million that you borrow, the cost might be relatively low, but as you keep trying to borrow after that, the cost will rise. So that's why, while this might not be a perfect straight line in reality, but clearly the general trend will be upwards for the marginal cost of capital. The other line that we look at is the investment opportunity schedule, or IOS. This refers to the sort of return that we are getting on projects. And as you can imagine, for the initial money that we invest in projects, clearly we will do the most profitable projects first. So the first 20 million that we invest will give us a relatively high IRR. So let's say that initially in our projects we can actually get an IRR of 30%. And then as we try to do more projects, then the return on those projects goes down. So, and as we keep doing projects, eventually we will run out of profitable projects, and then we might be somewhere over here where for this money spent, large amounts of money, as in when we are like spending a 200 millionth dollar, the return on projects then, or the IRR, is very low. So clearly the investment opportunity schedule is downward sloping. And the point to remember is that the optimal capital budget is at this point where the investment opportunity schedule is equal to the marginal cost of capital. And this should remind you a little, just as a quick refresher. In econ you studied about the profit maximizing point being the point where marginal revenue is equal to marginal cost. These are roughly analogous, but the basic point is this. Let's say that we are at this point A, and at this point A, notice that the IRR, or the return on projects, is more than the cost of capital. So it makes sense to keep going and invest some more. On the other hand, if you are at point B, then the cost of capital is greater than the return, and hence it makes sense to scale back. So the optimal point being this point X, which is the point where the two lines intersect, and that would be the optimal capital budget for a company. Now let's talk about the role of marginal cost of capital. The marginal cost of capital, or the WACC for additional units of capital, should be used as the discount rate when calculating a project's NPV for capital budgeting decisions. So in the last presentations on capital budgeting, the discount rate that we used is what we are talking about here. So that discount rate should be the weighted average cost of capital. However, adjustments to the cost of capital are necessary when a project differs in risk from the average risk of a firm's existing projects. So if we come up with a number that WACC is equal to 14%, this 14% is for average risk projects. If you have a high risk project, then you should use a rate that is greater than 14%, and for low risk projects you should use a rate that is less than 14%. And more details on this later when we talk about how to measure risk and when we talk about the CAPM formula. So the discount rate should be adjusted upwards for high risk projects and downwards for low risk projects as illustrated above. Now let's get into the details of how we come up with the different costs of capital. So how do we come up with RD, R for preferred shares and R for equity? Each source of capital has different costs because of the differences among the source, such as seniority, contractual commitments, potential value as a tax shield, and so on. And the primary sources of capital are debt, preferred equity, and common equity. So before we get into the details, just as a basic point, investors will demand a higher return. So they will demand a higher return if they are taking on a higher risk. So in the case of debt, preferred equity and common equity, the common shareholders are taking the highest risk and hence they will demand the highest return. And so after that comes preferred equity, so they are taking lower risk than common shareholders, so their return will be, or expected or required return will be less than common equity. And debt holders are taking the lowest risk, relatively speaking, because when a company makes money, there is a contractual obligation to first pay the interest to debt holders, and hence the required return for debt typically is the lowest of these three.